More on what seems like a little bit of a sigh of relief from the markets. Let's bring in Art Hogan, Chief Market Strategist with B. Riley Wealth Management. Art, always good to see you. Let me ask you the question that I just asked Greg Dacco. Are you seeing signs that inflation or disinflation is in the air?
Well, I can tell you this, the path of the CPI in February was a lot better than we were concerned about in January. I think that was true of the jobs report we just got for February, and likely will be true of the PPI and PCE. The problem is it's not happening fast enough, but it's certainly getting there in the right direction. I would also offer up that when owner's equivalent rent finally catches up with the reality of what's happening in housing prices, we'll likely see a precipitous fall off through the summer and into the fourth quarter. So we're likely going to see a core PCE that sits at or about 2.75% to 3.25% in the fourth quarter. At that point in time, the Fed will probably be at 5.25% on the terminal rate. I think that'll be plenty restrictive and likely what generates a rate cut in the first quarter of next year, being overly restrictive in their job getting close to being done.
Remind me, 5.25 would mean one or two more rate hikes of a quarter point?
Two more 25 basis points, likely to keep the same cadence and wrap things up in May. And I think what that does, Tyler, at that point in time is if they eventually pause, let's say they pause at 5.25, it's May, that kind of flips a switch in how we look at economic data. We'll stop looking at economic data through the lens of what does this mean for monetary policy, and we can actually celebrate strong jobs numbers and not be so concerned that this is going to jack the terminal rate up to 6 or 7%, something we were talking about as early as 2 weeks ago.
Give me some names of equities that you've got your eyes on in light of what you see as the interest rate environment, and in light of what you see, well, maybe you don't see, more talk of possible recession as we move into the third and fourth quarter of this year.
Yeah, I think if you look at the world and want to be defensive, which I think probably makes sense, at least for the first half of this year, you certainly want to look at things that you need versus things that you want and things that have strong balance sheets. So I would look at a company like Apple, which has got a fortress-like balance sheet. It's certainly shareholder-friendly, and both their buybacks, paying a dividend, and creating demand for goods and trading at a multiple unto itself that we haven't seen in quite some time. So very reasonable there. I would also offer up that a financial that's been beaten up in the sort of baby out with the bathwater environment we're in is JP Morgan. I think JP Morgan, looking at a JP Morgan and saying that somehow that's related in the exact same way to a SVB or a Signature Bank, and not actually a recipient of a lot of those deposits that have left those regional banks, it is probably the wrong way to look at it. So trading close to 1x book, and clearly a great value here. Again, a great management team, rock solid balance sheet. A third one I would offer up that's defensive in healthcare is AbbVie. It's got a very consistent dividend. It's one of the dividend aristocrats, and clearly a business that is well run, continues to reinvent themselves. So if you're thinking defensive with a lean toward perhaps things need to slow down here in the economy, those are three names that I would point to.